Hi, my name's Johnny and welcome to my channel, The Part-Time Investor. So today I'm going to talk about ETFs, not EFTs like I seem to say in my last video. Now ETF stands for Exchange Traded Fund. And now I know that sounds boring, but bear with me. So what is an ETF? Well, as the name suggests, it's a fund that is traded on an exchange, so a stock exchange. So a fund is just a place where people pool their money to buy securities like stocks and shares or bonds or anything else. And ETFs are just funds that you can buy and sell on a stock exchange. Okay, so why would you buy an ETF over buying an individual stock? Well, there's a couple of benefits to buying an ETF. First off, it offers you instant diversification. So an ETF is generally made up of a number of different stocks. So if you buy into, let's say, a very popular one is the S&P 500, that will either contain or model the performance of the S&P 500. So buying one unit of an S&P 500 ETF gives you exposure to those 500 companies. The next is they're often very low commission. That's not a problem with the app that I use, which is Trading 212, which has no commissions. But if you use another app or another broker, sometimes they'll have, say, a £10 commission for every stock, but usually the ETFs are lower than that or free. They can give you easy access to investing in sectors that you don't necessarily understand as well, like emerging markets, and they generally have a lower expense ratio or charge than similar types of mutual funds. Another benefit of ETFs is liquidity. Because you can buy and sell them on a stock exchange, you can buy and sell them within a day, whereas mutual funds, you can only do that once per day. And this might be important if you want to get out of a stock quickly. So the key one for me there is diversification and probably second, liquidity. And the reason why is because I am new to stock investing. And so any stock that I pick, I'm likely to be less experienced at picking a top performing stock than maybe someone who's been in it for a long time. Therefore, I want to make sure I'm reducing my risk as much as possible while still having an aggressive stock portfolio stance. And for me, I've decided 50% ETF versus 50% stocks is a half decent way of getting there. And over the year, I'm going to assess the performance of my ETFs against my stock picks. And maybe after a year, I'll decide actually it was much better just to put them into a couple of ETFs and let them do the job. Or I might decide actually I really enjoy picking different stocks and I want to continue to do that. And I'll maybe change my portfolio based on that. Okay, so let's say you've decided to invest in an ETF. How do you go about picking one? Well, first off, you got to do a bit of research and say which sectors you want to be invested in. So an ETF will generally follow a certain indices, whether that's the FTSE 100, S&P 500, certain emerging markets, gold, commodities, oil, pretty much anything you can think of. And ideally you want to be invested in more than one different asset class. So you might want to get a equities that follows the S&P 500 and one that follows a commodity like gold and one that tracks certain bonds in order to provide diversification not just within stocks but also across other different asset classes. Anyway, once you've decided where you want to invest in, then you've got to decide which ETF you want to invest in. And there'll be many different ones that follow the same indices. So there'll be a number of ETFs that track the S&P 500. So for instance, if you were on the Trading 212 app, which I think gives you access to about 300 different ETFs. If you use some other brokers such as AJ Bell or Hargreaves Lansdown, I think you've probably got access to about 2,000. But just focusing on the app that I trade on, which is Trading 212, you'd be able to access the Vanguard S&P 500 ETF with the ticker VUSA, and also the iShares S&P 500 ETF with the ticker IUSA. And on the face of it, other than the price, you won't really be able to tell the difference between the two, especially on the Trading 212 app, which doesn't really give you any additional information other than its current performance. So for instance, if you just Google VUSA, on the first page you'll find the Hargreaves Lansdown website, which I found gives a lot of good information on key statistics that you want to have a look at. These include the size of the fund and also the amount it's traded in one day. And if you scroll down a bit more, you'll get information on any charges, like for VUSA, which I think is 0.07%, so very, very small. And some information on the indicative spread, which is the difference between the buy and sell price. Ideally, you want that to be as tight as possible, and just means you'll be able to buy and sell stocks very quickly and for the price you want to do it. So once you've had a look at that and you're happy that, say, the fund is as big as you want it to be, I'm only looking at some of the biggest ETFs that are out there really, that the volume of trading is high enough, that the charges are low enough. Again, you want to go for as low as possible, as that's going to eat into your profits, and that things like dividend yields and everything else is where you want it to be, as it would just be for buying any other stock. So that's where there can be key differences between two ETFs that might follow the same index. One could be a lot smaller than another, and one could be traded a lot more than the other. Again, you want to go for the one that's bigger and traded more. After that, you could go and have a look at its performance over the years. If it's been operating for, say, 5 years, how did it perform over those 5 years against the other one? Now, you would think that an ETF that follows the same index is going to give you exactly the same performance. But it's not exactly the case, because they're all weighted slightly differently. For instance, if you look at VUSA, that's a full replication ETF. Full replication meaning that it owns every single stock within the index that it's tracking. Whereas if you look at IUSA, that is an optimized ETF, where it uses algorithms and calculations to own certain stocks within that index to try and track it as closely as possible. Now, both have their pros and cons, and you can decide which one you want to invest in based on all the things I've spoken about, its performance, and anything else you find out about that particular fund. So now you've decided to invest in a certain ETF, and you're happy that the ETF you're investing in meets all your requirements. There's just really one more thing you need to have in the back of your head. And that's, although ETFs do give you great diversification, they might not be as diversified as you first think. For instance, you might think that by investing in the FTSE 100, you are getting equal access to those 100 companies. So for the FTSE 100, saying it's 100 companies, it's actually just over, that each company makes up 1% of that fund. Well, that isn't actually the case, because these funds are generally weighted based on market capitalization. So the bigger the company, the higher weighting it has within that fund. And these are some potential downsides with ETFs. So if we have a look at the S&P 500, almost 20% of that is made up of what are called the FANG stocks. So that is Facebook, Apple, Amazon, Netflix, and Google. Although Google is actually Alphabet, so it should be FAN stocks maybe, I don't know. But that's what it's called. This is because those particular stocks have massively outperformed the market in the last 10 years, meaning they've grown to make up a larger proportion of the total index. Now, this has been good for the index because it's pulled up the rest of the worst performing stocks, but it does mean that if anything were to happen to those stocks, it would have a very large impact on the performance of that particular fund. So although you are diversified, you're still heavily weighted towards 5 tech sector related stocks. And don't think that by investing in, say, the FTSE 100, you're escaping from that, as the FTSE 100 is very heavily weighted towards gas and oil, financial and pharmaceutical companies. AstraZeneca and GlaxoSmithKline make up nearly 10%, BP's in there in the top 10%. So you're very heavily weighted towards a certain number of sectors. And again, that doesn't bode well when those sectors aren't performing great. So although it's not a reason not to invest in ETFs, it's definitely something to consider. Now, in recent years, there have been the introduction of what are called equally weighted ETFs, and they do what you think. Everything within that fund is equally weighted. Now, I've had a look on the Trading 212 app, which I currently use, and I can't see any equally weighted ETFs for me to invest in. So if you were wanting to invest in that kind of thing, then you might be better off going with the likes of Hargreaves Lansdown, AJ Bell, and the larger brokers. But as I'm currently not too bothered about that, and I prefer the fact that Trading 212 has no commission fees over the additional stocks and ETFs that you could buy with a larger broker, that's why I'm sticking with Trading 212. So that was my quick dive into ETFs. I'm just going to quickly show which ETFs I've invested in. They currently include iShares Physical Gold, which tracks the price of gold, iShares S&P 500 Information Technology ETF, which is heavily focused on the IT sector within the S&P 500. Then we get on to my Vanguard ETFs, which include the Vanguard FTSE 100, the Vanguard Emerging Markets, the Vanguard S&P 500 ETF, and the Vanguard UK Gilt ETF, which is invested in UK gilt bonds. Now, as it stands, these currently make up about 35% of my portfolio. As I've said before, I'm going to look to make that about 50% over the next couple of months and keep that up over the next year at least. So if we just compare the performance of my best performing ETF as it stands, which if you have a look is currently the Vanguard FTSE 100 ETF, which is currently 11.14% up. If you have a look at that against the performance of my whole stock, it's currently at 12.24% up. So my stock picks are outperforming my ETFs as it stands, but not by much. So if we were to have a look at my best performing stock pick, which is currently Carnival, currently up 37.22%. I mean, that's a lot more risky bet. It's just as likely to go down that much as it is to go up. So that gives you the difference between buying one stock and buying into a diversified set of stocks. I've seen the ETFs just slowly creep up over the last month, whereas my individual stock picks had varied much more widely than the ETFs over that time period. So although they're currently up, they could just as easily be down, and down by quite a lot. So I hope you enjoyed that video. If you do, please like and subscribe. It helps me out a lot. If you want to leave any comments, I do read them all and take on board anything you've got to say. And I'm always happy to learn from people who are doing the same thing as me or have been investing in the market for a lot longer. If you are looking at investing and are looking at the Trading 212 app, you can use a link in the description below, and if you invest £1, you can get a free stock up to the value of £100, and I get that same free stock, so it helps me out too. And I'm going to try and make one video a week, although I have been failing at that recently. It takes quite a long time to investigate and edit all these videos. But anyway, that's me for now. See you later.